Good evening, everyone. Thank you for joining us today. I am Waymon Williams, Home Loan Officer, Assistant Vice President with Carrollton Bank. We're going to be talking about budgeting and managing debt tonight. We're going to go over tips for paying off debt, tips for saving for emergencies. Okay. First thing we're going to talk about is budgeting. Preparing a spending plan. This is a key component to budgeting and managing debt. So the first thing that you want to do is keep track of your daily spending. You want to determine what your monthly income and expenses are the month before they're due. You want to find ways to decrease spending, find ways to increase income. Okay, step one. You want to keep track of your daily, weekly, and monthly spending. Probably one of the most important things as far as budgeting and managing debt is to make sure that you are banked, to make sure that you do have an existing bank account with a reputable institution. That will definitely allow you to track your money. Okay? What's the difference between a need and a want? Do you know where your money goes each month? To control your money, you need to understand where your money goes and keep a personal spending diary. A personal spending diary may not be something that's necessary, but if you are banked, there's online banking options that are available that will allow you to track your money. Step two, you want to determine income and expenses. Income is money that comes to you from your job, disability, child support, and other sources. Expenses are items you spend money on, including housing, utility, food, transportation expenses, and entertainment. What you really earn, okay? This is your income. Gross income minus your deductions is going to give you your net income, also known as your take-home pay. That's the important thing. Fluctuating pay can be scheduled hours, sick leave for you or your child that can impact your income. Those deductions that we talked about, they include federal and state income taxes, Social Security taxes, retirement and savings contributions that you may make, and premiums for medical insurance. So your gross income minus all of those deductions is going to give you that net income or your take-home pay. Okay, paying up, expenses. Social Security benefits. Social Security is like an insurance plan. It's also called FICA, which is the Federal Insurance Contributions Act. Those benefits include retirement, disability, family, survivor, and Medicare. So whenever you receive a paycheck and you see that Social Security is taken out, it goes out. It's taken out for those particular benefits that are listed there. You can always check the amount of benefits that you've earned so far at www.ssa.gov. You can go to that website. You can get a copy of your benefits statement to see what those benefits you currently have. It can help you plan for your future. So that's important information to know. Sometimes they do send out statements that tell you what your Social Security benefit amount is at the present. But always check that so that you know where you stand. Paying up. Expenses. Fixed expenses do not change from month to month. Some examples of fixed expenses are going to be rent, car payment, car insurance, and some utilities. Flexible expenses might change from month to month. Some examples of those are going to be your electricity, because that can change depending on the season, food, clothing, and entertainment, depending on how much money you spend on those items. Here's a tip at the bottom. You want to suspend cable for a few months to maybe save some money, or maybe consider some streaming options. That's something that's very popular now. You may want to consider budget billing for power sources, for winter and summer months, to kind of balance out the amount that you pay every month on those bills. You definitely want to avoid convenience stores, because those items typically are more expensive than they are in your regular grocery store or some of the warehouse stores. Step 3, decreasing spending. Decreasing spending equals increasing your cash flow. You have less money that you spent, that's going to allow you to have more money, of course. What are some ways you can decrease your spending? Some ways that you can decrease your spending are maybe eliminating some fast food, eliminating some unnecessary purchases. After you determine what your wants are versus your needs, maybe eliminate some of those wants. Step 4, increasing income. Other than finding a job or finding a job that pays more, what are some ways you can increase your income? Yard sale, online yard sale sites, that's a way to increase your income. You may pick up more hours at work, if that's an option. Ask for a raise in income. If you have a proven track record at work, talk to your supervisor. One thing about that, if you don't ask, you may not get it. Okay, here's the cycle of debt in a quote. Stop buying things you don't need with money you don't have to impress people you don't like. That's a quote from Dave Ramsey, a financial guru. I'm going to leave that there for a minute so that you see that. I think that's what happens with a lot of people is they buy things to impress others and they don't really need it. Okay, we're going to define debt. Debt is something, typically money, that is owed or due. Some examples of debt are going to be loans, whether it's for a car, house, or furniture. They're credit card bills that you have, maybe medical bills or student loans. Those are all examples of some debt here. The difference between debt and bills is once a debt is paid off, it's eliminated. Bills are typically payments for an ongoing service, such as utilities, cell phones, rent, insurance, etc. The belief is that you'll always have those payments. Okay? Debt with interest charges. Loans and credit cards charge interest for the privilege of usage. Here are a couple of examples here. A $10,000 car loan at a 4.4% interest rate for 6 years, which is equal to 72 payments, will cost you $11,396.23. So what that translates to is that 4.4% interest over the 6 years costs you $1,396.23. So that is the cost of that particular loan. Okay? $2,000 in credit card debt at a 15% interest rate, paying the minimum payment. You will make payments for 14 years for a total of $4,200 to pay off that balance. So take a look at that. If you just pay the minimum on that credit card, you're going to more than double the amount that you owe, and you're going to pay that for 14 years. So what you gain from that is that if you do have credit card debt, you want to try to pay that off as quickly as possible. Which leads us to this next slide, the minimum payment trap. Here's a tip. Ask yourself why a credit card company would accept such a small payment on a large balance. The answer is because they're making money on you. Credit card companies stay in business by people paying the minimum interest on that card. You pay the minimum, you're going to be paying that for a long time. Pay double the minimum payment to speed up the payoff and minimize the interest paid. Use the minimum payment option only when you're strapped for cash and to avoid any late fees. Okay? You want to always at least make the minimum payment on a credit card. Once that credit card is paid off, do not use credit cards for everyday purchases. Cut them up if you can't control using them. Now, the only thing that I would add to that, if you do have the ability to pay that credit card off on a monthly basis, then it's okay to use that. If you don't have the discipline or the ability to do that, you want to try to eliminate as much use of the credit card as you can. Next, we're going to talk about payday lenders and title loans. That quote there is very important. The only thing worse than one payday loan is two payday loans. The average payday loan customer takes out 8 loans for an average loan of $375 each, paying $520 in interest. That's almost $900. That's almost a $900 total for a $375 loan. Okay, so you more than double the payback of that loan. The average payday loan customer uses them to cover utilities, daily expenses, or credit card payments. We must stop working so hard for our money only to give it to people and corporations who don't need it. Okay? So a lot has been made about payday loans. There's been a lot of restrictions placed on those. There's been a lot of oversight. They still exist. If you have the ability to avoid those, you want to do that because they're very expensive, as you see here. They come with higher interest rates, big penalties if you don't pay them back, and if you don't make your payments on time. Getting out of the payday lender trap. One thing you want to do is pay all bills on time to avoid late fees and extra interest charges. Utilize a small dollar loan for a bank or nonprofit organization, which is why it's very important to be banked, to have a bank account with an established institution, because that may offer the opportunity for a small loan. Credit history prevents you from getting a loan from a traditional lender. Consider a credit building product. It will repair your credit while serving as a short-term savings account. Most banks, financial institutions, and credit unions and some nonprofit organizations do offer credit builder programs. If that's something that you're interested in, reach out to your financial institution and see what options they have available for those. But those are great because they do allow for the establishment or rebuilding of credit, and they also can act as a savings account. Once you do have a payday loan and you pay that off, do not utilize them. Try to avoid that. Okay. The next thing we're going to talk about is paying down existing debt. Most important thing is you have to make the commitment to get started. You want to rank your debts from the smallest to the largest. Make minimum monthly payments on all of the debts except the smallest balance debt. Put as much as you can afford into the smallest debt to allow you to pay that off faster. Once you pay off the smallest, work in order using that same tactic. So you're going to move on to the next debt, the next smallest debt. The great feeling of paying something off motivates you to keep working on that plan. So again, just revisiting in this slide, you want to start with your smallest amount of debt, pay that off as quickly as possible, move on to the next one. Next thing we're going to talk about is establishing an emergency fund. Question, why establish an emergency fund? Because it allows you to cover unexpected expenses, creates a habit of saving money, and it provides you with peace of mind. Here's some examples of emergencies versus non-emergencies. I think we all can consider, an unexpected car repair to be an emergency. Home repair can be an emergency. The kid may need new shoes. That's an emergency. An unexpected illness that may require you to be off from work and lose some income. Those are definitely emergencies. Non-emergencies. New purse, it's not an emergency, sorry. Going out to dinner, it's entertainment, it's fun, but it's not, an emergency. Holiday and birthday gifts. We all like to give gifts, we like to receive gifts, but it's not an emergency situation. You definitely don't want to go into debt doing that. Ongoing medicine really is not it's not a non-emergency. It falls more along the lines of maintaining and taking care of yourself kind of on a daily basis. There is a difference between an unplanned expense, an emergency, and an expense you didn't plan for, a non-emergency. An emergency fund relieves the pressure, gives you peace of mind, and helps you to plan for the future. Now, how do you establish that emergency fund? The goal is to shoot for $500, but start where you can. That money must be set aside in a savings account that you will not touch. Savings accounts do earn interest, so that's an additional benefit for that. So again, that goes back to our original point that you definitely want to be banked, have an established bank account that allows you to set aside that money separate from your checking account into your savings account. Start with $10 every week or whatever you can. You can make it an auto transfer so you won't miss that money. Online banking makes that very easy. That is what you would consider paying yourself first. So if you have a job, working, set some money aside, pay yourself first, whether it's through an emergency fund or establishing some type of retirement fund. Find places to save each week, put that money in your fund. Coupons, sell unused items, cut back on fast food, unnecessary expenses. That's all going to allow you to save some money. Tax returns. A lot of people do get that tax return. They may have it earmarked for something that may not necessarily be an emergency. may be a want as opposed to a need. Try to use some of that tax return money to set aside to establish that emergency fund. Again, ask for more hours at work if you can. That can give you an opportunity to work additional hours, maybe work some overtime, which is definitely going to generate some additional income for you. Here are a few more tips on emergency funds. $10 a week will give you $100 in just over 2 months. Deposit some or all of your tax return into your emergency fund, as we just talked about. 4 more hours a week at $9.50 an hour equates to about $25 to $30 per week for your emergency fund. Once you do establish that $500 emergency fund, work towards $1,000 using those same methods. Once your emergency fund is established, use that momentum to start tackling debt and saving more. Here's some more tips on emergency funds. Stop paying late fees on bills. Pay your bills on time. $37 credit card late fee 4 times a year equals $148. That's money that you did not necessarily have to pay if you pay your bills on time. Avoid those late fees. If you can't avoid that late fee, make sure you pay that bill within the month that it's due to avoid anything that can impact your credit. You want to cut back on added cell phone charges, fees, by controlling those data charges. Make a grocery list and stick to it. Very important thing, purchasing groceries is definitely a lot cheaper than fast food, but what you have to understand, that food that you purchase, you must consume. Because when you throw away leftovers, when you throw out food that's gone bad because you didn't use it, that's basically you throwing your money away. So it's important to grocery shop, but use the groceries that you purchase. Avoid purchasing items at gas stations or convenience stores because of the expense that's associated with them. They're going to be a little more expensive at those, or maybe even a lot more expensive at those gas stations and convenience stores than opposed to your regular grocery store or your warehouse store. Add up to 1 or 2 weeks of spending and see where your money goes. Cut back on things that can add up. If you're the type of person that does have a bank account and you use your debit card, track that spending to see where your money's going, understanding that every time you swipe that debit card, that there's money coming out of your account. Again, we're going to talk about wants versus needs. Needs are going to be housing. Everyone has to have somewhere to live. Transportation, whether it's a car or public transportation, you need a way to get back and forth to work. You always need insurance, health insurance, auto insurance, homeowners or renters insurance. Those are all insurances that you need. Gas and electric and food. Those are needs. Wants. Entertainment, going to the movies, amusement parks, things like that. Eating out, designer clothes, vacation, coffee, snack runs. Those are all things that you want. So here's a tip. Wants are not bad, but wants should be goals to work towards, not things you think you deserve even when the cash isn't there. Spending money that you don't have on wants can really put you in that cycle of debt, which we all want to get out of. Setting financial goals. Your goals should be SMART goals. And here's the SMART is an acronym for specific, measurable, adjustable, realistic, and time-oriented. Okay? So that is the acronym for SMART, which specific means you have to know what the goal is. Measurable, the goal has to be able to be achieved in a specific amount of time. Adjustable, meaning you can make changes to the goal if need be. If an emergency occurs, you may need to make some shifts. Realistic, it has to be a goal that's achievable to you. Time-oriented, again, you need to be able to achieve that goal in a specific amount of time. Setting a SMART goal. A general goal. I need to pay off credit card debt. The SMART goal aspect of that, which really lets you know what the plan is for paying off the credit card debt. So the SMART goal, again, I will pay off my credit card debt of $1,200 within 12 months by taking my lunch to work instead of eating out and drinking regular coffee instead of expensive lattes every day. $100 a month equals $1,200. Break that down a little bit more. $25 per week equals $1,200. $3.57 per day equals $1,200. $3.57 a day seems a lot easier than $1,200 in a year. Break your goals down and use that SMART method. Now, your next step for paying off that would be to find where I can reduce my spending by $3.57 a day. So that's how that works. Again, we'll go back to the SMART goal. It needs to be specific, measurable, adjustable, realistic, and time-oriented. And if you look in this middle section where it states the SMART goal, that covers all aspects of the SMART goal. There are 3 types of goals, okay? Once you have a SMART goal, break them down. You're going to have short-term goals within the next 6 months, intermediate-term goals, which can be achieved within the next 1 to 5 years, long-term goals, which are goals that are more than 5 years away. Here's some examples. Creating a budget. That's a short-term goal. You know, you may want to pay off some debt. Saving, whether it's going to be short-term, whether you're saving for a short-term, intermediate, or long-term goal, that's what that does. Investing, that's going to be a long-term goal. Investing is going to be a retirement fund, IRA, 401k. That's investing for your retirement, which is a long-term goal. In addition to SMART goals, putting them in order like this helps you to see the benefit of making a plan. One more thing to remember, debt isn't about character, and it shouldn't be something that causes you shame. You have the power to control your money if you make your money work for you. Okay, so don't be embarrassed about debt. Most people have debt. It's just about managing your debt, staying in control of your debt, and not letting it overwhelm you. Yes. Yes, it should be. A lot of people, if you have your online banking or if you bank, you have a checking and savings account option. The goal is to separate it from your checking account, to separate it from the money that you spend on a monthly basis. If you're able to have a separate savings account and then an additional emergency fund, that's a great thing. So the goal is to, save as much as you can, as often as you can. Okay? Yes. They're one and the same, pretty much. Payday loans are typically unsecured, let me say that. So they're going to have a higher interest rate because the risk is higher. Title loans are probably going to have a little bit lower interest rate than a payday loan because it's secured with the title to your vehicle. Okay? If you own your vehicle free and clear, they're going to basically put a lien against the vehicle and take hold to the title until you pay it off. If that isn't paid off, you run the risk of them taking your car. It's recommended that as soon as you can establish your credit. If you have established credit, you want to do that. Credit cards are not a bad thing. What you'll find in a lot of instances, you're required to have a credit card if you want to rent a car. There are just some things that require a credit card. If you have employment and you have the ability to pay that credit card, it's okay to open that and use it as needed, not overuse it. One of the guidelines that we have kind of in the mortgage industry is that 30% usage of the credit card is the ideal scenario, meaning if you have a credit card that has $1,000 available credit, your limit or your balance doesn't exceed $300. So that's an example of a 30% usage. Important thing about credit cards, pay attention to the interest rates. Ask questions about those. Always inquire what the interest rate is on a card. You always want to go with the lowest possible interest rate. Make sure, work on your credit. Make sure that your credit is established and your credit is in good standing. The better your credit score, the lower interest rate you should get on credit cards. Yes. That really depends on what you have left after you take care of your expenses. The general answer would be to save as much as you can, understanding that you still have some wants that you want to take care of or in addition to your needs. But my best thing would be to save as much as possible. That's the way I would phrase that. Yes. To do what? I'm sorry. The credit builder program, a lot of banks and credit unions do offer those, and the way that those credit builder programs work is they're typically in increments from $250 up to $1,000. What you would do, for example, if you have a $500 credit builder, they're called credit builder loans, but they're not really loans per se. What happens is you go to the financial institution, you complete the credit builder application. It's typically not an approval or a denial process. Basically, what you're doing with the credit builder is you're signing up and you're agreeing to make a payment for the next 12 months, okay? For a $500 credit builder loan, typically you're gonna pay $42 a month into that account. And what happens is the bank or financial institution is gonna report that payment to all three credit reporting agencies, Experian, TransUnion, and Equifax, and they're going to show that you're paying on a loan on a monthly basis. At the end of that 12-month period of time, that $42 a month is going to be $500. That money comes back to you. Benefit is that you've saved $500 over that 12-month period of time, and you have a 12-month pay history from all three credit reporting agencies showing that you have a satisfactory payment. So that's how the credit builder programs work. Again, they can start as low as $250. Can go as high as $2,000. It's just about how much you have available that you want to pay towards that. But it acts as a savings plan as well as building your credit. Yes, a lot of people that do the credit builders, they've already established bank accounts. They'll just set that up for an auto draft every month. It pulls from the account every month, reports to the credit bureau. You come in after 12 months, and you receive your money. It's called a credit builder CD. So it's money that's just set aside for you. It's your money. Yes, I would think so. I know our bank offers it. A lot of the local banks offer it. Credit unions offer it. There's some nonprofits that maybe even offer it. But I would definitely check with my bank or credit union, just ask them if they offer a credit builder product. I've even seen some commercials on TV, probably the past few months that, so it's definitely a thing that's taking off. Secured credit cards are an option as well for building credit. The way the secured credit cards work is, again, maybe a $250 to $500 limit that you put up front with whatever financial institution you have that secured credit card with. You use that credit card, you pay it off, and use it and pay it off, and that helps to build credit also. That's for the individual that may have trouble getting your traditional or standard credit card. So those are kind of the two credit building options that banks and financial institutions have: the credit builder and the secured credit card. All right, well, thank you.